Welcome! This is a basic introduction to synthetic selling. Hedging USD value by shorting up to 1x. This guide will briefly cover hedging using the perpetual swap, futures and options on Deribit. When trading on a spot exchange where you buy and sell Bitcoin for USD, if you wish to end your exposure to the Bitcoin price and maintain the dollar value of your account, you would simply sell into USD. On Deribit, there are no dollars to sell into, as the only balances are cryptocurrencies. However, you can still achieve the same by utilizing the derivatives that are available. You might have heard this being described as shorting 1x, hedging USD value, synthetic selling, or going into synthetic USD. The perpetual swaps, futures, and options can all be used to achieve this, so let's take a look at exactly how this is done, as well as the reasons you might choose each. First, the perpetual swaps. Hedging USD value via the perpetual swap is probably the most simple option, as the perpetual very closely tracks the price of the underlying asset. If, for example, you have a balance in your Deribit account of 1 Bitcoin, and the current price of Bitcoin is $10,000, you simply enter a short with a position size of $10,000, i.e. 1x your account balance. This position will mean your account balance will maintain its USD value of $10,000, no matter which way the price moves. The following two charts show firstly the profit and loss chart for the short hedge position previously described, in BTC. Secondary, the total value of your account in USD. In blue, you can see the short position, and in red, what would happen if you simply held the 1 BTC you started with. As you can see, without the short position, the line in red, you would not gain or lose any BTC. However, your account value measured in USD will change based on what price Bitcoin is at. This is because deposited cryptocurrency still has variable value. With the short position, in blue, the amount of Bitcoin you have will fluctuate based on Bitcoin's price. However, the USD value of your account remains constant at $10,000, no matter which price Bitcoin moves to. The short position completely hedges the dollar value. Shorting the perpetual does not come without drawbacks, however. Because they are perpetual, they don't have an expiry date, but they do have a funding mechanism. Put simply, the funding mechanism keeps the price in line with the index via small payments paid from one side of the trade to the other whenever the price deviates from the index too much. While this mechanism is very useful, it adds an unknown variable to your short. You could receive funding and make a little extra, or you could pay funding, meaning your USD value may decrease slightly. As you're not using high leverage, the impact should be quite small, particularly over short time frames. However, it's worth keeping in mind if you're planning to hold this hedge position for extended periods of time. If you wish to avoid the funding issue, you might consider using futures instead. As with the perpetual swaps, you simply open a short position equal to the value of your account. Unlike the perpetual, you don't have funding to worry about. However, futures are much more likely to be traded at a price further away from the index price. If they are trading higher than the index, you could capture this extra premium because you'll be shorting from a price higher than the index. If they are trading at a discount, however, this means you're shorting at a lower price from the index, which will cost you the difference if held until the expiry. The option route is a little less obvious, particularly to those who mainly trade futures, but it is possible to set up a position that acts exactly the same as a futures short using only options. To do this, you would sell an at-the-money or ATM call option and buy an at-the-money put option. As with futures and perpetuals, the quantities used are equal to your account balance. Occasionally, when prices are skewed in the right way, specifically when calls are more expensive than puts, this can be established for a net credit, which will provide a little extra bit of profit as well as providing the desired hedge. In most situations though, this likely won't be the most cost-effective or time-effective choice. You see, options often have a wider spread than futures, So filling both legs at a favourable price may be difficult and/or time-consuming in comparison. And if you wanted to open and close the position several times, this problem is multiplied. So why does this type of hedge work? This isn't always intuitive for traders not used to using an asset as collateral for margin trading. That is, the dollar price of the same asset. For example, trading the Bitcoin US dollar or BTC USD pair and using Bitcoin as collateral instead of dollars. As you are using Bitcoin as collateral, you're already long that amount of Bitcoin simply by holding it, and so have exposure to the variable Bitcoin value against a dollar. A 1x short essentially just offsets your 1x long, leaving you flat with no exposure to the Bitcoin price. As the price moves up, so does the value of your remaining collateral in USD terms, such that it perfectly offsets the losses of your short. Incidentally, this is why you have no liquidation price if you are short for 1x or less on your account balance. If the price moves down, the BTC you are already holding goes down in value, but you gain more BTC from your short position at a rate that perfectly offsets this fall in value. In a perfect hedge, the dollar value of your account remains the same, but the shown equity total in the header is the amount of Bitcoin you could purchase using the dollar value in your account. For reference, you can see the current USD value of your account by hovering over the equity in the header. In summary, the perpetual futures and options can all be used to hedge against the downside risk of a volatile asset, without having to sell via a spot exchange. This way, a trader can take advantage of the lower fees, higher liquidity, and funding payments, to name a few of the advantages of a derivatives exchange. This was a basic overview of hedging USD value by shorting 1x. Thank you very much for watching.